gold is consolidating at a very high level, and the next move, which is starting now, however fast it will be, it could be very fast, is going to take us to highs that no one can imagine. As the crowd always waits until it makes headline news in papers and on television, everybody will pile into gold, of course. And on top of that, as I said, sovereign governments will also have to hold gold as a reserve asset. So that journey is just starting, and as I said, will be a major move.
Safe haven gold eased on Monday, hitting pause after jumping to within striking distance of the key $2,000 level in the last session as traders positioned for further developments on the Middle East conflict and U.S. economic data. Egon von Greyerz believes the gold market is in a high-priced consolidation phase. This consolidation is seen as a precursor to a significant upward move. The speed of this impending surge remains uncertain, but it has the potential to be remarkably fast and drive gold to unprecedented, unimaginable highs. Even the famous analyst David Meagher, director of metals trading at High Ridge Futures, said, "Safe haven demand will continue to drive gold higher after a slight period of consolidation. We believe geopolitical tensions and the uncertainty in the Middle East will continue to drive prices higher. Gold has consolidated at or near peak levels in different currencies, except the US dollar, which has seen temporary strength. Notably, Egon mentions the potential for a major global event, such as a war, which could lead to changes in reserve assets and substantially impact gold prices. Gold prices have surged to their highest level in over a week in response to the ongoing Israel-Hamas war and dovish comments from key U.S. Federal Reserve officials, according to reports from Reuters. Regarding the long-term outlook, Egon envisions a scenario where gold becomes the preferred reserve asset for central banks, overtaking the U.S. dollar. Central banks bought a staggering $70 billion of gold in 2022, the most since 1950. As heightened macroeconomic and geopolitical uncertainty drove governments to accumulate the precious metal. As central banks in the East accumulate gold, this trend is expected to gain momentum, creating a substantial demand for gold. Egon predicts a gradual price revaluation over time, not a sudden reset, given the historical pace of significant shifts. We will bring you clips from Egon von Greyerz' interview with Liberty and Finance. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The real move and the real journey in gold hasn't started yet. It's about to start now, and also technically, this last correction that we saw in gold a couple of weeks ago, or just over a week ago, really, that was the final correction of a small correction we're talking about. Remember, and I think now the gold is on its way to a lot higher levels. And remember, gold has been now consolidating in most currencies at the top, at the peak, even in dollars at the peak. Okay, it's not much higher than it was in 2011-12. At that peak in dollars, because the dollar has been strong temporarily, in my view. But in all other currencies, gold has made a new high. This is gold goes up for several reasons, but one is, of course, just because we measure it in money that goes down in value the whole time. So just by printing more money, gold will go up automatically because we value it in money that falls in value. But the other thing is that the real catalyst for gold is very often that events happen, major events, and here we have a potential major event of global war. And that linked to, as I said, change in reserve assets in the world. So, that I'm afraid that the high gold price that I could see in coming years is going to be in a world that is not going to be easy or pleasant to live in, definitely. So that's why we shouldn't wish for high gold. We should just hold it as insurance. It's like when you buy fire insurance. You don't buy it because you wish your house to burn down. Just if it burns down, it's good to have. And here, the advantage of gold is that it's not just an insurance that you need to pay a premium for every year to renew. Gold holds its value better than any money or any investment throughout history. So it's a wonderful insurance to hold. On top of that, it actually looks good too and shines. Uh, yes, and people will now wake up to that too. But as I said, it's going to be a bit late, and it's going to be at the time, as I said, when there'll be a lot of other problems than just worrying about finances.
Record debts, high interest rates, the costs of climate change, health and pension spending as the population ages, and fractious politics are stoking fears of a financial market crisis in big developed economies. A surge in government borrowing costs has put high debt in the spotlight, with investors demanding increased compensation to hold long-term bonds and policymakers urging caution on public finances. The global debt has reached an astonishing $330 trillion, but the true extent of the derivative market remains elusive due to its shadowy nature. Egon estimates that the derivative market could be as large as $1.5 to $2 quadrillion, posing a significant risk. If the debt market or U.S. Treasuries encounter challenges, these derivatives may require intervention by central banks, necessitating substantial financial support. Egon envisions either exponential growth or collapse in the financial system. Given the substantial risks, he advises individuals to safeguard their assets, especially from a financial perspective. Precious metals like gold have a track record of serving as dependable hedges against economic uncertainties, offering security for those with savings. Let's get back to the interview.
The derivatives market, most financial transactions have an element of derivatives in them. And a lot of transactions have a lot of derivatives in them. I mean, a lot of funds, etc., have no real assets or real paper in them. They have just synthetic ones created by derivatives. And of course, so you're not talking about only a global debt of 330 trillion or so. You are, and I've written about this. You're talking about it could be. The total derivatives, nobody knows what they are because you have this shadow market and you have outside of balance sheets, etc. But in my estimate, the derivatives could certainly be 1.5 quadrillion or more, maybe up to 2. And that's really what you're looking at here. That has to unwind at some point. If the debt market comes under pressure and if the U.S. Treasuries come under pressure. And so if those derivatives will at some point have to be saved, if you want, by central banks, so they will issue even more money to save the banks and to buy derivatives, etc. And that's why, and this is why you see how exponential growth or exponential collapse can happen so quickly. I think we're not there yet, but that can come out of the blue. I don't want to be a prophet of gloom and doom, and I'm because nobody knows what's going to happen, or how it's going to happen, or when it's going to happen. But we do know is that the risk is now at a level where it's never been in history, as far as I'm concerned, because we have never had a crisis. Financial crisis, a debt crisis of this magnitude before. We never had bubbles of this magnitude before globally. It's existed in certain countries in the past, but not across the world. And this is why there's no one to save you. Sure, in the past, if Argentina went under, or some South American country, or some East European country, etc., then it could be saved by other sovereign states. Now there's no one big enough to save. First of all, you got the U.S. No one can save the U.S. The Ponzi scheme is finished, and 2008 was a rehearsal. 2006-9, if you want, was a rehearsal, and miraculously they managed to delay the problem for another few years, or quite a long time, 15 years. But now it's time. I don't believe that money printing will save it. So we are in for a very vicious time now. And as I said, we don't know when. All we know is that the risk is there. It's going to happen. It could happen tomorrow. It could take a year. It could take 5 years or whatever. But the only thing we know is that The people who can, they should try to protect the assets that they have. At least you can't protect everything, your family, etc. It's much more difficult. But nevertheless, I mean, physically you can't. It's not that easy to protect everyone when you are talking about a war. But nevertheless, financially, we can all, anybody who has a bit of savings, owning gold and a bit of silver also, this is why we 25 years ago went into gold. We saw gold as the best protection against what was coming, against the risk. And the good thing is that is that if you hold gold, over time, every single currency has gone to zero without exception, over thousands of years.
The gold price could potentially see additional gains if the Middle East conflict were to escalate or expand. This is why gold is considered a haven, as it performs well during economic distress. Where do you see the price of gold going in the future? Share your observations in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.